Good morning, everyone. Today, we're going to continue our discussion on MPT, Modern Portfolio Analytics, Modern Portfolio Theory, as developed by Harry Markovits. So there were some principles that we were looking at last time, like, for example, in MPT, in Modern Portfolio Theory, we talk about risk and return trade-off, which means that rationally, an investor would be willing to take on a greater amount of risk if if the person is compensated for a greater amount of return. That's a rational behavior. But according also to finance, so behavioral finance, sometimes investors will not behave in this way. But generally, class investors who assume a greater amount of risk would want to be compensated with a greater return. Okay, then we have the concept of diversification. According to Harry Markovits, the in a portfolio, you will be able to minimize the risk if you diversify your assets. Okay, so we looked at the difference between systematic risk and unsystematic risk last time. Then we also discussed about the concept of efficient frontier. Okay, in the efficient frontier, it's a plot where you will find the optimal portfolio given a certain portfolio. You'll find there the different weights. Okay, for a given risk, there is one optimal portfolio that will give you the greatest amount of risk. And the optimal portfolio, the efficient frontier, we looked at via an illustration last time. Okay, then of course, as I mentioned a while ago, the optimal portfolio. For every level of risk, there exists a portfolio that maximizes the returns, and that can be seen in the efficient frontier. So investors can select the best portfolio using the efficient frontier based on their risk tolerance. So given the level of risk, if you're a risk taker, you can require a greater amount of risk, and you can identify the weights of the asset that you can have in your portfolio, because that will give you a higher return compared to the other portfolios in that range of risk. Okay, so the objective of this exercise is for us to be able to uh, I plot the efficient frontier, okay, from which you can find the optimal portfolio. When you say portfolio, of course, you are identifying the weights of the assets in your portfolio. So we're going to make use of this, okay, quant mode, QMAO, for performance analytics and portfolio analytics. So I hope you have run this. Let me just rerun this. Okay, and maybe let me, okay, for us to be in the same page, let me delete first all the objects here. Okay, so I'm deleting all the objects so that uh, I'll just regenerate the objects that we created last time. Okay. All right, so what we're going to do now is let's you can just change class, because I think last time we used 2023. So let's just use the start date at 2015 and then ending at 2023, 12/31. So let's use the same assets that we were working on last time: IBM, uh, Bank of America, Wells Fargo, American Express, the Tower Semiconductor, and Pfizer. So this is the portfolio of 6 assets that we're using as an example. So since I already deleted this in my environment, I'm going to run this code chunk again. Okay, and we have now here the vectors, character vector end, character vector start, and then I have here a character vector of 6 items, IBM, the names of the tickers. Okay, so I'll go through this very quickly because we have already done this in the past. Then we make use of the get symbols function of quant mode in order to load our data. So we identified the ticker, the object as stickers, and then from we identify the start and end date, and then periodicity is daily, and auto data assign is equal to true. So let me run this. And we now have the objects here, the XTS object. Okay. All right. So let me pause for a while and ask you if you're able to follow along. Kindly chat, please. We have done this in the past. Okay. So I'm sure you have these codes already. Okay, good. Thank you. All right. To be honest with you, I'm happy if you're responding. Okay, which means it means to me a lot to me because it means that you're able to follow the lessons that we're having. Okay, and I guarantee you, maybe this may or may not, maybe most probably this may be the only subject you're going to use learn portfolio analytics and other analytics tools using R. I don't know about the other subjects, but since you have only one financial analytics, and I don't know what your plans are in the future, but uh, after this subject, make it a point to always hone your skills in R. I think you're in a position already to improve or enhance your skill set in R. And also, as I said, uh, expand also by learning Python. Because once you know R, plus it's easy to learn Python. Okay, so we said that we can make use of the QMAO uh, package to use the make price frame. And then this is the code that we already did before. So I'm creating an object here called PF. You can name it any way you want. It's price frame. And then we identify the start date, end date, and what do we want for QMAO to get from the objects, from tickers. And we're using adjusted, then na.omit and silent is equal to true. Then we're going to view it, going to run this. So we have now our PF object here. It's an XTS object containing all the adjusted prices of our XTS objects from IBM, Bank of America, Wells Fargo, American Express, etc. Okay. So now that we have that, we can now generate our return frame. Okay. We can make use of the RF function here. Okay. Same thing, but we also, okay, although it's quite redundant because it's already adjusted. So which means that if we have once we have these objects, IBM, back, etc., we can go directly to the RF code, okay, and just get the returns. Okay, so if you don't really need the PF object here, where you contain the prices, adjusted prices of all your assets, you can just go directly to your RF and it will generate the returns. Okay, so have I run this? Ret, not yet. So I'm going to create this object ret. Okay, you may name it any way you want, but for purposes of following along, you may just use the name that I used here. Okay, ret, and then I'm putting this here na.omit. Okay, because we know that this will generate the first line to be an NA object. Okay, so same thing, run this. Then we have this ret object. Okay, so you can see here the daily returns. Okay, others, for others, what they want is they would want the returns to be in percentage. So you can type 100 there. Okay, so you want because sometimes the daily returns could be very, very, very low, very small. So if you want it to be scaled to percentage, if I run this, you'll notice that now the figures are 100-fold, right? So it's now negative 1.586. Okay, others prefer it this way because it gives them a, it's quite difficult sometimes if the decimals are quite, if the long, no, or big. Okay, so, but let's just remove this. Let's just use the value itself. So I'm going to rerun this. Okay, then back to the uh, original figures. Okay, let me pause again for a while and ask you, class. Okay, so far, are we clear? Okay, thank you. Okay, good. Waiting for the others to, if you have any questions, please feel free to. Any questions so far, class? Clear naman? Okay, good. Feel free to ask questions, class, if you have any. All right, so last time what we did was to study the concept of returns, right? And risk, returns and risk. And we learned that you can easily compute for the return of, we have two types of returns, right? Either we have the, okay, you have the discrete returns of an asset, which we, okay, this just defined as the price at time t over the price at time t minus 1 minus 1. So that's our discrete returns. And then we have the continuous or log returns, which is just the log of the price at time t over the price at time t minus 1. Okay, so this is just equal to the log of price at time t minus the log of the price at time t minus 1. Okay, and in R, this is easy because you'll just get the difference of the log of your, of whatever your asset is. Okay, diff log. So it will first take the log, okay, and then get the difference. So this, it will be equivalent to this one. Okay, so we learned that before. In this case, the returns that we got here from the ret object is continuous, or this is the log returns. So let me just, okay. So going back to the return object, we can get the average of the returns of each of the asset. Just get the uh, uh, average return of IBM, average return of BAC, etc. This is the returns of the single asset class. Okay, so for example, the mean of the ret is our object, and then IBM. Okay, so the return of IBM is 0.0019. That's the average. Okay, and the variance, we can also get the variance and the covariance of the returns. The variance of AXP of American Express is just var. Okay, and the covariance between two assets is the covariance of Bank of America and Pfizer. Okay, of course, class, uh, the covariance of AXP, okay, we said this last time, class, that the variance of AXP is just the same as the covariance of AXP with AXP. So if I run this, of course, we'll get the same answer. Okay. Okay. So we also did the portfolio risk, and we said that by definition, okay, sorry, by definition, the return of a portfolio is simply equal to the uh, weighted returns. Okay, you just multiply the weight and the returns, and then sum them up. to get your portfolio return. So that's very easy, but the more challenging one is your portfolio variance, which we define as matrix algebra. It's weight transpose times your variance covariance multiplied by the weight transpose. Okay, so this is what we did last time. So let's have a quick review of that. Let me clear drawings. Okay, and then what we did last time, class, was this is of course this is more, say, a better way to do it, because last time when we were starting, what we did was to just define our weights as 1/6, 1/6, 1/6. So of course that will be not a good way to do it, especially if you have a portfolio of 20 assets. So that means you will have to write 1/20 20 times. So we can do this. We define the weights. Let's create this object n, and n is the number of columns of our return object. So this is our ret object, and we know there are 6 columns there. So we can make use of that. Okay, so here I'm defining it to be n is equal to n call of ret. So if I run this, I'm sure that we will now have a vector here, okay, in the data there, 6L, which means L here means, if you watch the video for the first week, L here means this is an integer. Okay, 6L. Okay, and then we create this object weights, which is we're asking R to repeat 1/n, and then how many times? Rep stands for repeat. So repeat 1/n, where n is 6, and the number of times is 6. So let me run this. All right, then we can find here numerical vector 1, 1 to 6, and they're all 0.167, which is 1/6. Okay, so let me again pause for a while, and you can, I suggest that you do this, class, instead of typing the 1/6, which is more manual. Okay, this is a, let's say, more, this is a better way of writing the weights. Okay, let me pause for a while, and for those of you who would want to copy this, okay, I'll give you the time to do that. If you're done, class, kindly chat, please. That's just a one line of code. Okay, good. Let's give a chance to the others. Okay, good. All right. So we have the option, class, to use the mathematical approach. We can, of course, we can, okay, as I wrote a while ago, our return of the portfolio is just the sum of the weights times W sub I, and then ret the return, right? The return. So actually, we can also use matrix algebra, okay? Because our weights, the weights here, class, although here in the data, it's specified, it seems to be given columnar way. Actually, for vectors in R, it's given as in row formation, okay? Row wise. So this is actually 0.167, 0.167, 0.167, etc. So it's a 1/6 matrix. Okay, sorry, it's a 6/1 matrix. Okay, 6/1 matrix, and then if we're going to multiply it by the returns matrix, the ret matrix. Okay, you have here your IBM asset 1, 2, 3, 4, 5, 6. Okay, if we're going to multiply this, class, we're going to multiply this. This is a 6/6 matrix. We said that we will have to get the transpose of this because this is not multiplicable. So we will have to make this a transpose of 1 by 6, right? To make this multiplicable. All right. Okay, so you'll be able to get the return of each of the assets there. But we're not going to do that. If you want, you can, of course, you can try that. You have the weights object, then just get the transpose, right? Transpose of the weight. And then you multiply it with your returns matrix. So as you know, in R, matrix multiplication is like this. Okay, so this should be the way to do it. Okay, so I leave that to you as an exercise to investigate if you'll be getting the same answer as this one. Okay, so let me clear this. Okay, so here we're creating this object, ret port, return portfolio. We're using the performance analytics and then use this function, return that portfolio. So we're told what object, what portfolio are we using? We're using the ret portfolio here. It's a portfolio of returns, okay? And then we have to identify the weights, okay? Because as you know, the portfolio return is equal to the vector of weights multiplied the vector of the portfolio. Okay, so this one, class. So let me run this ret underscore port return of the portfolio. Okay, and let me view that. So you now have class. Okay, just one just one column. Okay. Now, why is this one column? If I look at return that port, what's happening now is that for this day, there are 6 assets. Okay, so you multiply each by 1 over 6, 1 over 6, 1 over 6, etc. And then you have the contribution for this day, the total returns of each of the returns here of the different assets, its average or its weighted return. The weighted return in this case is simply the average because it's equally weighted. So this is times 1, 6, times 1, 6, etc. Or it's just the same as adding all of this and dividing by 6. So it's the same as getting the average, okay, for day 1. So the average return for day 1, okay, let's go here. Portfolio, no, not here. Red port here. This is the average return for day 1. Okay, just for curiosity's sake, okay, let's see. If I copy this line, okay, Control C, just copy it in the console, Control V, okay. So let me get the mean. Okay, I'm getting the mean of this, okay, just to illustrate. Sorry. Oops. Point 0.0. Just to satisfy our curiosity. Okay, so I just added all, I just got all of this class, all of our figures here, and get the mean of this. Let's see, mean of all of this. It's getting the mean is simply just getting the average of all of this, or just adding up all of this and then dividing it by the number of observations, in this case 6. So the mean is negative 0.01586. Let's see if this is the same. Oops, sorry. What did I do wrong? Did I get the correct? This is negative 1012.01922. Anything I missed out here, class? Okay, could you help me look at what's wrong here? May mali ba ako dito, class? 0.015, 0.029, 0.027, 0.026, 0.0099, and one. Yeah, this is correct. All right. Anyway, class, but that should be, I don't know what's wrong with my formulation here. Baka may mali ako na copy or something. Okay, anyway, so I'm getting a different answer. Okay, sorry about that. I just wanted to test, class. Okay, magkaiba eh. Magkaiba. Tama na, 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5, 6. Supposed to, even if I use, okay, let me just manually do this. I'm just adding, okay, add everything and then divide by 6. It's the same. Okay? Ayun. Bakit kaya? Tama na to, 192. Hmm. Okay, anyway, class. So I don't know what happened with my main function. Okay, so it's 922. Yeah, this is right. So you're just adding up all your all your returns and then dividing it by 6. Okay, so let's go back here. This is not really that important. I just wanted to validate, but we got it anyway. All right, so this is the, you can notice now that you have now a return portfolio. And this is a portfolio of the return of your portfolio of assets, or 6 assets. And every day now you have only one returns. Okay, one return for each of the day of your 2,263 observations. Okay, pause again for a while, class. Any questions? Are you able to follow, class? Let me just pause for a while, a few seconds, and then give you a chance to ask questions if you have any. Kindly chat, please, if you're able to follow along. Yes lang, please, or yeah, thank you. Okay, good, good. All right. So thank you so much for your response. Now this is now our red portfolio. Okay, I'm just going to change the column name. Yeah, it's too long for me. So let me just change the column name of our object with red port. I'll just name it the same way as our object. So just run this, and then let me check red port just to uh, lessen the time. Okay, so we learned last time that for the returns it's very easy. For the risk, it's we used this formula last time. So just a quick review about this. Let me just share the LaTeX if you want to copy it. Okay, so this is just the LaTeX. It's weight transpose times sigma times weight. Now take note, class, I'm doing here weight transpose. Okay, okay. I'll just replace this by capital T. Okay. because we know that the weight, if you generate a vector, it will be uh, the number of rows by 1. It will be a columnar vector. Okay, so that's why I'm using the weight transpose, and then our sigma is our variance covariance, which we can easily compute, okay, using the cov function. Okay, we did this last time. Okay, so let me just review it. So I'm again generating this cov matrix, which is the variance covariance. And then if we check this, we now have this. Okay, so it's a matrix. Okay. All right. So sometimes others, as I said, would want to make this into percent. So if I multiply that by 100, okay, my variance covariance will now be, okay, what happened? 1, 2, 3. Did it change? Right. Yeah. So this is now in percent. Okay. We just scaled it. Okay, but just to be consistent with the others, let me just, okay. Then this is what we did last time. We said that the variance of the portfolio will be equal to the transpose of the weights matrix multiplied by our variance covariance, okay, and then multiplied by the weights matrix again. So we did this last time, and then we got the square root of that to generate the standard deviation, okay. So that was the standard deviation of our portfolio point 141, 14%. That was the, okay, 0.14. And our var port was 0.0198, okay? And then the square root of that will give us the standard deviation, which is 0.14. Okay, pause again for a while, class, and please chat if you're able to follow along. Okay, waiting for your response, class. Okay, thank you. Okay. All right. So also last time we did this one. So just by way of review, okay. So let me just share this because we have done this already in the past, Control C. And we said that we looked at the concept of rebalancing because we're going to repeat this. Okay. All right. So here in our discussion, we said that there's an advantage of rebalancing. It will put back our portfolio to the weight that we would want it to be in. So we said that we can use the return that portfolio function from the performance analytics, and then use our return portfolio, okay? And then we have to define the weights, which is 1/6 in our case, and then we have to define the rebalancing. So we did this last time. Let's just redo this for purposes of review. Okay. So I now have this object ret port rebalance. Okay. So it's also a portfolio. But let me just change also. Let me change the. Okay, never mind. Because I changed it already here. All right, and then we can compare class the returns. So we're generating this object where we put in one data frame our ret port and ret port rebalance. Let's do that here. So ret port all Okay. So this one we haven't changed yet. Okay. So I changed it here nevertheless. No? So and then we replace the portfolio names by non-rebalance and monthly rebalance. And then we use the table that annualized returns. So this will compute the annualized returns because we have daily returns. And then we have to define the risk-free rate. We are assuming it to be 6% annual. Okay. Then we have to divide this by 252. Okay. I mean, yeah, divided by 252. Okay. And then let's run this. All right. Then we have a comparison of the non-rebalance and monthly rebalance. As in last time, we saw that the monthly rebalance had a higher annualized returns, and in this case, it had a higher standard deviation, and but a lower negative, well, quote unquote, lower negative, which means that it has a relatively higher annualized Sharpe ratio because it has a lower negative. Okay, these things, class, these are usually the context of many researchers. So comparing, for example, a usual portfolio where there's no rebalancing vis-a-vis a either monthly rebalance or quarterly rebalance, a portfolio, and you make use of some metrics like Sharpe ratio, which we which we discussed last time. All right. So let's now go to our main topic, which is portfolio optimization. So let me just first, okay. So let me share in the chat box some of the notes here. Okay. So portfolio optimization, we have here 6 steps. And number one, we define the portfolio returns to be optimized. So we create a returns portfolio. We define the assets there. Of course, before we can create the returns portfolio, we have to identify the assets in our portfolio and then compute for the returns, as we have shown just a while ago. Okay, we have 6 assets: IBM, Bank of America, Wells Fargo, uh, American Express, and then the Tower Semiconductor, and Pfizer. Okay, we access the data, the prices, and then we computed for the returns. Okay, and then we after we computed for the returns, then we generated the portfolio returns. Okay, so that's the first step. Define the portfolio returns to be be optimized. For the first example that we're going to have, we will create this object port one, and it will just consist of IBM and Bank of America. So this is coming from our, let me just close this. So we have this return object class. So we have IBM and BAC. So let's just choose the first 2 assets here. That will be our returns first. That will be our, let's just use a 2 asset portfolio. Okay. So the first step class is to define the portfolio returns to be optimized. So I'm creating this object port 1, and it's coming from the return portfolio. Okay, this one. And I'm just subsetting here the first 2 columns. Okay, so you know this contains all the rows and then the first 2 columns. And then, so we're creating this, and then let's view this. All right, so I'll give you a few seconds to please generate that. And when you have created your port 1, so please chat in the chat box so that I know if you have created the object port 1, which consists of the returns of IBM and Bank of America. How about the others, class? Waiting for the others. All right, so if we check our object port one, okay, let me check that. Where's my port one? Oh, have I? No, I haven't run it. I'll run this one. Okay, and there we go. Port one is a 2-asset portfolio. Okay, now that we have our 2-asset portfolio, okay, then just like the one we did a while ago, let's now create our port one ret. Okay, so we have portfolio one, which consists of the returns of all the assets. So we'll create just the returns of the portfolio. Okay, so we're going to create this object now, port one ret. Okay, and then you have, again, we're going to use performance analytics, the function return that portfolio, and then the return that it will be, portfolio return that will be it create is from port one, our port one object, and then our weights class is, again, we use the rep function 1 over n, where we defined our n to be the number of columns of portfolio 1 over n comma n. So this is just the same as the function above class. Okay, then we view it, and then we change the column names, port one vet. All right, so I'll give you a few seconds again to do this, class, and then kindly tell me, class. Okay, so running this class, we'll create this object port one with ret, which if we show it here, so this is our portfolio one ret consisting of the returns of IBM and BAC. Okay, so we have the portfolio returns now. We can plot it, class. All right, and we can see here the return of our portfolio consisting of IBM and Bank of America. Okay, so all right, so we're now going to this is part of step one, class, is define the portfolio returns to be optimized, is to create this class. Okay, so here I'm creating this object port spec one, and the function is portfolio specification. So before we can create the optimal portfolio, we have to do this. Okay, so let's do this. Let's seek the help of portfolio.spec. Okay, portfolio.spec. So what is this all about? So this is now coming from portfolio analytics now, class, not the performance analytics. Okay, so the portfolio object is created with portfolio.spec. So it's an S3 object of class portfolio used to hold the initial asset weights, constraints, objectives, and other information about the portfolio. So it's like a container, for lack of a better word. It's a container where you put your the elements of your portfolio. Like you will identify the weights of your portfolio, the constraints, objectives, okay, and other information about that portfolio. So it's just like a again, I forgot the term for that, but let me just use a container, okay, a container for your portfolio. Okay, And here, class, are some of the elements of our portfolio. All right, so let's create that class. Okay. So here, let's create this port spec one. Okay, and we're using this portfolio.spec. So as I said, this is now from your portfolio analytics. Okay. Assets. Our assets class is equal to here. Our assets, let me just put this here. So we're defining our assets to be the column names of port one. Okay, because our port one class, okay, what's our port one? Port one, where's our port one? Port one consists of, this is our, okay, this consists of IBM and BAC. All right. So we're defining that the name of our portfolio spec, the assets names are the call names of port one. Okay. So let me check if this is assets is equal to call names of port one, call names. Okay. 1, 2, and 2. Okay. All right. Portfolio.spec. Let me see, class. Let me just put it back here. I just want to see if so portfolio.spec and then assets, okay, is equal to column names of port one. All right. So I think this is correct. Okay, and then let's run this. Okay. And then you have here, because I printed port spec one, and then you have here, okay, so portfolio analytics, portfolio specification. That's the object we have. And so far, this is the formula that we generated, and we just identified the number of assets, which are IBM and BAC. Okay, so once again, class, may I request you to please chat in the chat box if you're able to follow along with this. So that's the first step, specifying what our portfolio is. And the first thing that we did is just identify the names. Okay, good. Okay, so let's wait for your other classmates. You're 30 all in all, and so far, I just have responses from 10. So let's wait for them. All right, so that's the first step, class. So as we said, step one is define the portfolio returns to be optimized, okay? And I think I should put here uh, and the portfolio object, portfolio specification object. So kindly just add this. Step one, define the portfolio returns to be optimized and the portfolio specification object. All right, so, okay, I hope you have this already. Now let's go to step two. For step two, let me share this with you, class. Add the constraints, and I'm going to share with you a link. Okay, let's open that link, class. No? This is from Portfolio Analytics, and it gives us a definition of what this function is all about. So it's this one. All right. So we're now going to add that constraint. Okay, that's the step two. We need to add the constraint. So this is the general interface for adding or updating portfolio optimization constraints. All right. So the function is add that constraint. Then we have to define our portfolio, and then there are some functionalities here that we can use here, class. Okay. So marami to, no? Weight some leverage, full investments. Some of this we're going to use yung box constraint, long only. For the others, we will not be using them, class. Okay, so we'll just use the some of the let's say the basic ones, and then here you can have this example. You can run this. Okay, you can run this as an example. Okay, so let's go back to our R. All right, I'll give you some. Okay, let's just do this first. So take a look at this. So the object that we created a while ago is port spec 1, right? Okay, so this is our container. And we specified that to contain the port 1 object, IBM, and BAC. So here, we're going to add to this port spec 1. As I said, it's a container, and then we're going to add constraint now. Okay, so first one, portfolio spec. Second, add that constraint. Okay, and the function is, what's the portfolio? Our portfolio is this one, port spec 1. And then here, what's the type? You have here, so the first thing that we're going to include here is the type. Okay, that's a type class, full investment. Okay, so okay, kindly write this first class. We'll do this step by step. And what is full investment class? Okay, going back to the reference, the URL, okay, that we used a while ago. Does full invest what does is full investment here included? Okay, this one class. Take a look at this. Full investment. So what do we mean by full investment? I hope you're seeing this. Okay, special case to set minimum sum is equal to 100% or maximum sum is equal to 100 and maximum sum is equal to 100% of some weight sum constraints. All right, let me explain this briefly. Okay, so you recall, class, that in a portfolio, we're investing in our different assets, and how do you operationalize the investments? You put, let's say, 70. So you have your capital, let's say 1 million, and then you say that 70% of this capital will go to this asset, and 30% will go to that asset. All right. So you have, for example, for our IBM and BAC, if we are choosing a 50-50 proportion, then our weight 1 is 50%, our weight 2 is 50% also. And the sum of that is 100%. So just like the object that we used a while ago where we have 6 assets, and then we wanted an equally weighted portfolio. So the percentage of weight 1 is around 16.7%. Weight 2 is 16.7% until weight 6, which is also 16.7%. And the total of that is 100%. So that's what we mean, class, by full investment. So for full investment, it strictly imposes that the sum of the weight should be 100%. Now, it's specified here because later on we'll realize that sometimes the solution might not converge. Sometimes the solution might have difficulty generating a 50-50 or a full investment. Okay, because we're going to add more constraints later on. But for now, class, please understand that what we mean by full investment is that the total weight, the minimum total weight, minimum sum is 100%. The maximum sum is 100%, which means there can be no other sum. Okay? So let me clarify that. It means, class, that the sum of your portfolio, okay, this full investment here, class, means that if you sum up your weights, it should equal to 1 or 100%. It should equate to 1. So, hindi pa pwedeng 99% lang siya. Or hindi siya pa pwedeng 101%. Okay? These are not allowed. Okay, that's what we mean by full investment. Okay, again, let me pause for a while. Is there any questions, class? Clear ba so far, class, itong full investment? Okay, good. Thank you. All right. So the alternative, class, is this one. Okay. So you may put this under comments first. Add constraint. Portfolio is equal to port spec 1, and then type is not full investment but weight sum, and then you can define minimum sum to be 99% and maximum sum to be 1.01%. So which means the model can have a total sum of 99%, or it can have a total of 101%. Now, sometimes there may be a need to relax the full investment constraint because sometimes R might not be able to generate a solution where either, for example, you're minimizing risk, and then that it has to be the weight should be equal to 100%. Okay, so for now, class, for now, please understand that full investment just means 100% yung minimum weight and 100% yung maximum weight. If that's the case, then it means, class, that the weight should be equal to 100%. No more, no less. And then, but it has a provision that if you don't like the 100%, if you want R to generate a range, either 99% up to not lower than 99%, but not greater than 101%, then we can make use of this. Not full investment, but weight sum, and then you define what's the minimum and what's the maximum. Okay, let me pause again, class, for some feedback from you, for some comments. For now, class, we'll just focus on the full investment. Is this clear, class? Okay, waiting for your feedback, class. Okay, thank you. All right, so let me clear this up first. Okay, so what happens now is that you can add on to constraint. Okay, so here I am adding another line here, class. Port spec, and then add that constraint. As I told you a while ago, this is like a container. Okay, so you put there first your object port spec, and then you keep on adding. We add constraint. Our first constraint is type is equal to full investment. And then we have another constraint here, long only. Okay, so kindly write that first. And then let's discuss what does long only mean. And I'd like to ask you, have you discussed in your financial other fin subject the long position and short position? For example, in portfolios, stock investments. What do you mean by having a long position or a short position? Anyone, class? Long position, short position. Anyone? Okay, just just please chat yes or no so that I know if I need to discuss this. Have you discussed? Have you met? Thank you, Francis. How about the others? Yung long position at saka short position. Okay. Okay, good. Thank you. All right. So I was anticipating that you have not heard this. Okay, so I put here some notes for your reference. Okay, this one. So let me share this with you in the chat box. You may copy this, class. All right, so let's discuss this quickly. So you have a stock investment. What does having a long position in an asset mean? Okay, when you say long position, it means that you own the security. So why would you, why do you own that security? Okay, because the rationale behind is that you expect that that stock will rise in value in the future. Okay, so why do you invest in that? You invest in a particular asset because you know that the value of that asset will increase in the future. All right, how about a short position? So the opposite of the long position is a short position. All right, so in the Philippines, this is not yet allowed, but in the US, this is allowed. So a short position is when you sell a stock that you do not own. Okay, so for some investors who are well known, for example, by their stockbrokers, pwede sila, pinapautang sila, no? So you quote unquote borrow a stock that you do not own. And why will you do that? Because you're anticipating that the price of the stock will go down in value. So what do? You quote unquote borrow, let's say that stock with the anticipation, bababa yung value niyan. Okay, so what happens? If the price drops, okay, so what do? If the price drops, then you will buy the stock at that lower price, and then you're able to make a profit, di ba? If the price of that stock rises and you buy it back later at the higher price, then of course you will incur a loss. No? So yung short selling para sa ano yan, medyo malaki na experience sa ganyan, no? Okay? So short means you're selling a stock, uh, uh, you're in a position where you you're you're selling a stock that you do not own. Okay? Now, bakit ka quote unquote humiram ng asset na yon? Kasi ang ano mo, ang alam mo is the price of that stock will go down. Okay? And when it goes down, then you buy. Okay? At that lower price. Bakit ka bibili, class? Kasi ibabalik mo sa piniraman mo, no? So binenta mo na muna, binenta mo at 100 pesos. Okay? So you generated cash, di ba? Later on, kunyari, the price of that asset went down, naging 95 pesos. E di, bibili ka ngayon para ibalik mo dun sa pinaghiraman mo, no? So you sold it at 100 and then you're buying it now at 95. So that's what we mean by a short position. All right. So in this case, class, ito, no? Nag-add tayo ng constraint dito na long only. Ibig sabihin, short position is not allowed. Okay? Hindi ka pa pwedeng hindi ka pa pwedeng magbenta ng asset that you do not own. Okay? So long only yan. Long only position. And then going back, class, dito may box pa dito, no? Ano yung box dito? Here. So andito, class, yung long only, no? Long only, and then pero iba yung ano dito, Okay, iba yung definition ng long only dito. Special case to set minimum is equal to 0 and maximum is equal to 1 of the box. Okay. So okay, let me class, let me just clarify what I said a while ago. So yung long only, class, in the case of add that constraint, medyo iba yung ano nila dito, no? So what I was sharing with you, yung long only, class, is quite different in meaning, no? So medyo iba yung context ng tanaw. Iba yung context ng long only dito sa sa Well, in a sense, pareho lang siya, no? Okay, I'll tell you why, class. Ang ibig sabihin ng long only dito, minimum is equal to, minimum ng mga weights is equal to 0. So, ibig sabihin, pwedeng maglagay ka ng 0 weight sa isang asset, tapos ang maximum niyan, 100. Okay? Kasi class, pag short position, ibig sabihin nun negative eh. Negative yung asset mo, no? Right? So dito hindi pa pwedeng magkaroon ng short position na may negative. So that's what this means, no? So consistent pa rin siya dun sa meaning natin. Okay? So AKA class, also known as itong long only na to, ang minimum na pwede mo ng weight ng isang asset 0%, ang maximum is 100%. Okay? All right. Then you can also include yung box, no? Type is equal to box. Okay, dito class, di ba, minimum is equal to 100%, maximum is equal to 100%. So dito pwede mong i-refine yung long only. Here you're saying minimum is equal to 0.1. Ibig sabihin nun, walang asset weight ang pwedeng bumaba ng 10%. So ibig sabihin lahat ng assets mo, ang minimum na weight nila, 10%. Tapos maximum, let's say 70%. Of course, this is, it depends really on, let's say, what you want your portfolio to be. Gusto ko sa portfolio ko, walang asset na more than 50%. So, gagawin mo tong 0.5. Tapos gusto ko, walang minimum na, let's say, 20%. Then you will put there 0.2. Okay? So, sineset mo lang dyan na yung mga weights dapat hindi bababa ng gantong weight at saka hindi tataas ng gantong weight. Sa long only class, okay, if you really want 0% and 100%, long only na. But if you want class na medyo may ano ka pang restriction, ayaw mo kasi pag long only, pwedeng ang isang asset pwedeng 0% ang weight niya eh. Ibig sabihin walang investment ang ilalagay doon. But if you want all the assets to have to have at least a certain proportion, then specify mo. 10% ba yung minimum or maximum, ilang percent. All right? So, okay, so I'll give you a few seconds to bilis ng time, no? Eh, class, itong portfolio analytics, hindi pa tapos yung ginagawa ko. Naka 400 plus, ano na ako, lines of code. Pero it's okay, class. Kasi, again, hindi naman sprint yung ginagawa natin, no? Ang gusto ko talaga, ma-appreciate natin to. Alright, so I'm going to run this class. Okay, so paki-run na lang din to. So still part of ano to, step 2, no? Where we add constraints to the object that we created a while ago. Notice class, port spec 1, tapos pagdating dito, port spec 1 pa rin. Okay? As I said, yung port spec 1, parang siyang container. So lagay tayo ng lagay dyan. Okay? Yung una, ang ginawa natin, di ba? Ito, portfolio.spec. So, define natin to, create natin. Tapos, pangalawa, nag-add constraint tayo. So, let me now, wait. So, yung port spec 1 ko ito, no? It's a list of 6. There. Okay. So, sabi niya, ang assets natin, dalawa. Okay? Ang default niya, 0.5, 0.5. Tapos, wala pa tayong constraints, wala pa tayong objectives. Okay? So yung category labels 0 pa siya, wala pang laman. Kasi hindi pa natin tapos yung port spec 1 natin. So let me go here, class, and then let me run this full code chunk. So full investment class, ibig sabihin, dapat ang sum 100%. And then here, although may long only dito tayo, tapos may box pa tayo dito, ang magpe-prevail dito class, yung minimum is 10%, no? Ang maximum 70%. Instead of 0 and then 1. So technically class, itong long only, okay, hindi na kailangan to kung maglalagay tayo ng minimum ng 10% at saka 70%. Okay? So we can just comment this out class, no? Itong long only na to. Kasi ang long only, di ba, minimum 0, maximum 70. So let me just comment this out class. Kasi ang gagawin natin dito, minimum 10%, maximum 70%. All right, so let me run this. Okay. Okay, but ano siya? Kasi nasama tong ano dito, no? Ayan, okay. Parang na-separate yung ano, yung type is equal to long only. Ngayon naka-blue na siya. Kanina hindi siya naka-blue class, no? Which means that it was not part of the comment. Okay? Ngayon, nag-backspace ako, blue na siya, part ng comment na siya. So let me rerun this. Okay. So let me now check our port spec. Ito. All right. So notice now, so our constraints now, nadagdagan siya kanina. Kanina list nito 0 eh. So if I click this, ayan no. Okay. Meron na tayo dito na okay, weight sum constraints. Tapos may weight sum constraints dito. Hindi siya naka-specify dito. Okay, if I put this down. Okay. So, parang na-doble siya, no? Kasi full investment, full investment. Okay, parang pareho lang siya. Parang na-doble class yung ano ko, yung constraint 1. Okay. And then, asa na yung isa? Okay. The other one class is number 3. Ito yung box constraint, no? There. Kita nyo, class? Minimum 10%, maximum 70%. Bakit dalawa siya, class? Kasi dalawa yung assets natin, di ba? 10% minimum for asset 1 for IBM, 10% minimum for Bank of America, 70%, 70% maximum. Okay. Naran yung long only. Okay. Go back, no? Go back lang. Tapos, go back lang. Tapos, i-comment out mo na lang siya. And then, i-run mo ulit to. Okay, let me do that, no? Paano ko na-run natin to? Okay lang, wala namang problema doon, no? That one. So, anong nangyari ngayon dito? Nagkaroon ako ng constraints na 6 na, no? Okay? So may na-doble na akong constraints dito. Okay, if you want to go back, if you want to redo that class, so siguro balikan na lang dito, no? Go back here to the initial, yung port spec 1. Yan. So doing that now, babalikan na naman dito yung port spec 1. Wala na naman siya laman, no? So go back to the first step. Okay? Go back to the first step. I-run natin ulit siya. Wala na naman siyang laman ulit. Tapos, go back now to your first constraint. This one. Okay? Tapos, as I said, comment out na lang siya. There. Alright, then run. Okay, then we check this. So ngayon, constraint natin 2. Kaya nag-treat to kanina class kasi na-run ko na kanina yung ano eh, yung full investment, no? So ngayon, dalawa na lang to. Weight sum constraint, this is the full investment, this is the box constraint. Again, class, ang difference nito, yung weight sum constraint, you're summing up the weights, no? Ang sum ng weights dapat 100%. Ito na ang box constraint, yung limitation ng bawat isang asset. Okay, 10% and minimum 70% maximum. All right. Okay, so we'll end here in step 3 class. So ano si step 3? Kasi medyo mahaba na yung ano, no? It's almost time. So sulat ko na lang to, Control C, and then i-chat ko na lang. Okay. So this is step 3A, no? Ano laman ito? Okay. All right. So Mag-ano tayo class ng i-add natin yung objective natin. Okay? I-add natin yung objective natin. Alright, take a look at what I did here. So dito ang ginawa ko class, nag-create ako ng panibagong object, ang tawag ko port min var1. Why? Para ma-preserve ko pa rin yung unang-una, no, yung port spec 1. So ito yung port spec 1 natin, di ba? Nalagyan na natin constraints dito. Now, if you want to preserve this, ang ginawa ko ngayon, nag-create pa ako ng isang object na port min var. Okay? Kasi mamaya pwede natin gamitin ulit yung port spec 1 for maximizing returns. Ito kasi ang gagawin natin, we will be minimizing the risk. Okay, yun ang unang ano natin, yun ang unang gagawin natin ng portfolio. So, kanina, 'di ba, add that constraint. Ngayon, add that objective. Okay? So, in the interest of time, i-share ko na lang sa inyo 'to. Control C. Chat sa time na class. All right. So, copy niyo lang please. And then take a look at this class. So, si port min var1 is just the same as port spec 1, no? It means that I would want to preserve yung port spec 1. Okay? And then mag-a-add na ako ng objective. Okay? So, add that objective, ang portfolio ko is ito na, si port min var. Anong purpose ko nito? Later on class, if I want another objective, I can still use port spec 1. Okay? And then type is equal to risk and then name is equal to standard deviation. So ito na yung objective na gagamitin natin. Kasi sabi natin, ang objective pwedeng minimize risk or optimize or maximize your return or pwedeng combination ng dalawa. No? Alright, so I'm going to run this now and tingnan natin kung anong laman ni min var ngayon. Alright, tingnan nyo class. No? May objective na siya dito. Andun yung constraints kanina na dalawa, tapos andi dito si objective. There. And the objective is, let me, there class, no? Ang objective is standard deviation there. Okay? Yan ang standard deviation natin. Tapos yung formula natin, add that objective, yan. Name is equal to standard deviation. So, next meeting class, ang gagawin natin dito, itutuloy natin to, and then we will now run our portfolio. We will ask R to generate a portfolio where risk is minimized. No? So ano kayang portfolio ang magbibigay sa atin ng minimum risk? That's what we're going to answer next meeting. Okay? Or, baguhin natin, maximize returns. Pwede rin yun. Objective na minimum risk or maximize returns or a combination of the two. All right? So let me stop recording now.